Bitcoin and crypto in general plunging again this morning, now threatening Bitcoin at least to break under 30,000 and already below some of the recent lows that we've seen.
But what surprised me and us generally was to watch MicroStrategy, which has put all the cash on its balance sheet into Bitcoin.
Last week, we became the first company to do a senior secured debt offering to buy Bitcoin.
What's been interesting this time around is if you look at Google search trends for Bitcoin or Bitcoin's price against the Bitcoin price itself, you'll find that there's not a lot of speculative activity by that measure. In fact, in 2017, they were 1 for 1 together, but it has been pretty quiescent until maybe very recently, but throughout last year. And so that gave us a lot of comfort. We believe that the institutional behavior and moves recently have been fascinating. We have been expecting institutions to start moving into Bitcoin and other crypto assets, but primarily Bitcoin, the most secure of the blockchains, because if you look at the correlation of Bitcoin's performance relative to any other asset class, it has the lowest correlation, meaning if you buy some Bitcoin, you will further diversify your portfolio and increase your returns with lower risk, right? So that's why institutions look for that low correlation. Bitcoin has it. And so that's clear. We have 10 years of history now. But what surprised me and us generally was to watch MicroStrategy, which has put all the cash on its balance sheet into Bitcoin, and even did another equity offering so it could put more cash on its balance sheet. And I think that's a little crazy because I think the regulators will have something to say about this in terms of what is this? Is this company the MicroStrategy technology company, or is it like an ETF? So we don't know about that. But then you saw Square put 1% of all of its assets in Bitcoin. And I think you're going to see more of that. We didn't expect that. What we did expect was, because of the low correlation of returns, institutional investors to move in. The most surprising one to me thus far has been MassMutual. It put $100 million into its general account. Now, its general account is enormous. So $100 million is something like 0.001. But what that move told us is, MassMutual is very conservative and very highly regulated. And so it had to jump through many more regulatory hurdles than I thought would have been possible by now. So I think that is a seal of approval. And then, of course, you have the institutional infrastructure moving into place, whether it's with custody, and everyone knows a lot about Fidelity being out there in terms of wanting to custody Bitcoin in particular. You have the Intercontinental Exchange, and you've got the CME now with Bitcoin futures, one settling in kind, one settling in cash. And so we do believe that Bitcoin is getting ready for institutional. But when we actually think about this, is Bitcoin ready for institutions? Bitcoin is it's roughly a $600 billion market cap. So not even half the size of Apple or Amazon, right?
Yep.
Doesn't put it into perspective. And yet it is a very big idea. I think a much bigger idea than Apple or Amazon. It's the first truly global digital currency out there. And it is completely decentralized. There's no throat to choke. So unlike with Libra, you had Europe and the US and many countries saying, we'll never allow this. That's because there was one throat to choke. With Bitcoin, there's no throat to choke. And in fact, when China basically shut down the exchanges in China that dealt in crypto, especially Bitcoin, that activity just moved over to Japan, Thailand, and Korea, other countries that wanted to move ahead in this innovation space. They did not want to miss this next big thing. Well, we have a very disciplined process. And so our minimum hurdle rate of return for a stock to enter the portfolio is 15% at a compound annual rate over 5 years. We expect the stocks in our portfolio to double over the next 5 years. Now, when you have big runs, as we did last year, a lot of stocks drop below that 15% as a 5-year expectation. And so when they drop into the 10 to 15%, we'll be taking profits. So we are selling, if they're core to our platforms, then we will probably sell, if we think it's gotten way out of hand, we'll sell it down to 50 basis points. We've gone from 10% to 50 basis points in stocks and exiting some as well. Even if they are core, we just think, okay, they're going to need a long time to grow into this valuation. And we don't want to live with or sit with dead money. But then we will get corrections like the coronavirus, right? And what we do during a correction, we will have sold stocks that are core. For example, 2U and Teladoc are they were in both our next generation internet portfolio and our flagship before the coronavirus. Both of them benefited from stay at home. They started moving up as other of our stocks were crashing. They moved up to such a point, they dropped below the 15% as these others were giving us opportunities to deliver 50% plus at a compound annual rate. That's at the beginning of last year. At the beginning of last year, that number, that 5-year number was 42%. Today it's closer to 20%. But stock by stock, we're looking at that 15%, and the more it falls below, the more profits we will take. So we have such a creative research team, however, and there are so many stocks vying for our attention, and with these IPOs, vying for a position in our portfolios, that when a stock drops below 15%, we know there's something else waiting, knocking at our door, waiting to get in.